One wrong decision with your student loans could cost you tens of thousands of dollars, and most people don't even realize they're making it. Today, we're breaking down the two options that confuse almost everyone: consolidation and refinancing. If you're staring at a mountain of student debt from different lenders and wondering what your next move should be, this video is for you. We're going to break down exactly what each option means, who it's for, and how to decide which path might be right for your financial future. It might sound complicated, but I promise by the end of this, you'll have a much clearer picture. First up, let's talk about consolidation. So, what is it? Think of consolidation as spring cleaning for your federal student loans. If you have multiple federal loans, maybe a Stafford loan here, a Perkins loan there, all with different payment dates and servicers, it can feel like you're juggling way too much. Federal direct consolidation allows you to combine all those federal loans into a single new federal loan. The result? You now have just one monthly payment to one servicer. Super simple, right? Now, let's talk about the interest rate. This is a key point. When you consolidate your federal loans, your new interest rate isn't necessarily lower. Instead, it's a weighted average of the interest rates on your original loans, rounded up to the nearest 1/8%. So you might not save money on interest, but the big win here is simplicity and convenience. If this already sounds familiar, stick with me, because refinancing is where most people make a costly mistake. Imagine going from tracking 5 different payments to just one. That alone can be a huge stress reliever. So, who is federal consolidation good for? It's a fantastic option for borrowers who are struggling to keep track of multiple federal loan payments and want to simplify their financial life. It's also the only way to make certain older federal loans, like FFEL or Perkins loans, eligible for newer income-driven repayment plans, or programs like Public Service Loan Forgiveness, also known as PSLF. If you're aiming for loan forgiveness through one of these federal programs, consolidation might be a necessary step to get all your loans on the right track. But there are some things to be aware of. When you consolidate, any outstanding interest on your old loans gets capitalized. This means it's added to your principal balance, and you'll start paying interest on a slightly larger amount. Also, and this is important, consolidating can reset the clock on any progress you've made toward forgiveness on income-driven repayment plans. So if you're already, say, 5 years into a 20-year forgiveness plan, you might want to think carefully before consolidating and resetting that timeline back to zero. Okay, let's switch gears and talk about refinancing. This is where things get a bit different. Refinancing is when you take out a brand new loan from a private lender, like a bank, a credit union, or an online lender, to pay off your existing student loans. You can refinance federal loans, private loans, or a mix of both. The goal here is usually to get a lower interest rate, which could save you a significant amount of money over the life of your loan. A lower interest rate also means a lower monthly payment, which can free up cash for other financial goals. How does refinancing work? Unlike federal consolidation, private lenders will look closely at your financial health. They'll check your credit score, your income, and your debt-to-income ratio. If you have a strong credit history and a stable income, you're more likely to qualify for a lower interest rate than what you're currently paying. You can often choose between a fixed interest rate, which stays the same, or a variable rate, which can change over time. Many lenders also offer different loan terms. Maybe you want to pay it off faster in 5 years, or stretch it out over 15 years. So, who should consider refinancing? It's a great strategy for borrowers who have a steady job, a good credit score, and are looking to save money on interest. If you have high-interest private loans, refinancing can be a game changer. It's also an option for people with federal loans who are confident they won't need the unique protections that come with them. For example, if you have a stable, high income, and a large emergency fund, you might feel comfortable giving up federal benefits for a lower interest rate. But here comes the big warning for refinancing. This is the most crucial difference you need to understand. When you refinance federal student loans with a private lender, they become private loans forever. You cannot turn them back into federal loans. This means you permanently lose access to all federal loan benefits. What are those benefits? Things like income-driven repayment plans that can lower your monthly payment based on your income, federal deferment and forbearance options if you lose your job, and access to federal loan forgiveness programs like Public Service Loan Forgiveness. This is a massive trade-off. Saving money on interest is amazing, but giving up that federal safety net is a big decision that you shouldn't take lightly. Before you refinance any federal loans, you need to be absolutely sure that you won't need those protections down the road. If your job is unstable, or if you're pursuing a career in public service and banking on PSLF, refinancing your federal loans is probably not the right move for you. So let's put it all together in a head-to-head comparison. Consolidation is a federal program for federal loans. The main benefit is simplicity: one loan, one payment. Your interest rate is a weighted average, so you likely won't save much money, but you maintain all your federal benefits. In fact, it can even unlock access to certain federal programs. Refinancing, on the other hand, is done with a private lender and can include both federal and private loans. The main benefit is financial, getting a lower interest rate to save money and lower your monthly payment. However, it requires good credit and a stable income. And if you refinance federal loans, you permanently lose access to all federal protections and forgiveness programs. So, how do you choose? It really boils down to your personal situation and your priorities. Ask yourself these questions. What is my main goal? Is it to simplify my payments, or is it to save as much money as possible on interest? What kind of loans do I have? Are they all federal, all private, or a mix? How stable is my income and my career? And finally, how important are the federal protections and forgiveness programs to me? If you have multiple federal loans and your main goal is to get organized and maybe qualify for PSLF, federal consolidation is likely your answer. You keep your safety net and you make your life easier. If you have excellent credit, a secure job, a healthy emergency fund, and high-interest private loans, refinancing could be a brilliant financial move that saves you thousands. If you have federal loans but you're very confident you won't need the federal benefits, refinancing could also be a good option to lower your interest rate. But what if you have a mix of federal and private loans? One popular strategy is to do both. You could consolidate your federal loans to keep them federal and simplify them, while separately refinancing your private loans with a private lender to get a lower interest rate. This way, you get the best of both worlds. You optimize your private loans for savings while keeping the crucial safety net for your federal loans. Making the right choice can feel overwhelming, but remember, you have options. Do your research, run the numbers using online calculators, and get quotes from multiple refinancing lenders to see what rates you might qualify for. Don't rush the decision. Take your time to understand the long-term implications of each choice. Your future self will thank you for being thoughtful and strategic about your student debt. I hope this breakdown helped clear up the confusion between consolidation and refinancing. It's a critical piece of the student loan puzzle, and understanding the difference is the first step toward taking control of your debt. If you found this video helpful, please give it a thumbs up and hit that subscribe button for more content on managing your money. And as always, if you have questions, drop them in the comments below. I do my best to read and respond to as many as I can. Thanks for watching, and I'll see you in the next video.